right? If you're a saver in the UK, chances are your money's tucked away somewhere pretty safe. Maybe a bank account, perhaps an ISA, but probably low risk. But what happens when the government steps in and, well, actively encourages millions to move away from that safety net and dive into the stock market?
Welcome back to the Deep Dive. We break down complex policies, pull out the key bits for you. And today, we're focusing squarely on a pretty major policy shift coming from the UK government, specifically the Chancellor, all about how everyday people, like you, invest their savings.
That's right. That's the heart of it today. We've gone through the source material talking about this new retail investment campaign. And our mission really is for you listening to get a quick handle on not just what the government is doing here. I mean, it's a big push to get everyday savers into shares and funds directly. But also, crucially, why now? And, what levers are they actually pulling to make this happen? Okay, let's talk timing first. Because the source is making clear this isn't just talk anymore, is it? The Chancellor's officially launched this campaign. But maybe we should step back a second. Why this big push? What's the problem they're actually trying to solve by nudging savers towards riskier assets right now?
Well, what's really interesting, I think, is how it connects to these bigger economic anxieties in the UK. It's quite structural. If you look at the wider picture, the UK has these ongoing challenges with productivity, market liquidity. Compared to somewhere like the US, for instance, the level of retail investment here is, well, it's a lot lower. We tend to have more of a saving culture, perhaps, especially among younger people rather than an investing one. And that means UK companies often end up relying more heavily on big institutional investors or maybe capital from overseas.
Ah, I see. So the government sort of looks at all this cash sitting in savings accounts, maybe not earning much, and sees it as potential fuel, untapped potential for UK businesses. They want to get that retail money moving, essentially, to boost liquidity, support growth here at home.
Precisely. Yeah, it's definitely a strategic move. They see it as fixing a kind of market failure, this inability to channel domestic savings efficiently into domestic investment. And the goal is very clear. Get everyday savers into shares and funds. This isn't really aimed at the super wealthy. It's about changing the behavior of that average saver, the person who currently prefers the safety of a savings account even with low returns. The government's basically trying to normalize the idea that holding market assets is or should be the default, not the exception.
Wow, okay. That sounds like quite a fundamental shift they're trying to engineer, almost cultural. But let's get practical. How are they actually going to do it? How do you convince millions of people to rethink their approach to risk?
Yeah, it definitely takes more than just asking nicely. The sources point to a kind of three-pronged approach. It's a mix, really, a blend of regulation, tax policy, and a big communication effort, all designed to make investing look much more attractive and, frankly, easier.
Okay, let's break those down. The first tool you mentioned, new tax breaks.
Yes, this is probably the most direct lever they can pull. You can expect some quite specific, targeted tax advantages. The aim is clearly to make the difference in after-tax returns between saving and investing much wider. So maybe we'll see things like higher contribution limits for tax-friendly accounts, or perhaps new allowances specifically for investing, maybe even favoring UK stocks. The basic idea. Make the tax savings so good that just leaving cash sitting there starts to feel, well, a bit irrational financially.
Right, so they're using tax to make it almost painful not to get involved in the markets.
Okay.
What about the second point, the broader incentives?
Yeah, the sources talk about incentives more broadly as ways to lower the barriers to actually start investing. So this could involve regulatory tweaks, perhaps forcing investment platforms to lower their fees, or making the sign-up process for brokerage accounts much simpler.
Less hassle, lower costs.
Right.
Trying to make buying a share feel as easy as, say, opening a new savings account online.
Okay, less friction. And the third part, the marketing push. This is where the story comes in, I suppose.
Exactly. And this is really crucial. This isn't some behind-the-scenes policy tweak. It's meant to be very public. It's a dedicated campaign designed to, normalize investing and encourage people to actually do it. And the key theme, the buzzword they're using, and the sources highlight this, is democratizing investing.
Democratizing. That's a powerful word, isn't it? Sounds positive, like opening things up for everyone. But often in finance policy, that word carries a bit of baggage. Is it genuinely about equal access for all, or is it maybe more about getting more money flowing into the city, increasing liquidity?
That's a fair challenge.
Yeah.
I mean, the official narrative, as presented in the sources, is definitely about lowering those barriers that historically kept investing for the wealthy or the professionals. And mechanically speaking, if you lower fees and simplify access, then yes, you are making the ability to invest more democratic. However, as you say, there's an inherent tension. Because when you democratize access to markets, you also inevitably democratize risk. This policy is actively pushing people, often people who are naturally quite risk-averse with their money, into assets that can go down as well as up, volatile assets. So the marketing push has a tricky job. Make the benefits, like those tax breaks, feel really concrete and immediate, while making the risk seem perhaps a bit more abstract or manageable.
Yeah, that feels like the really tricky part because we've seen it before, haven't we? Government pushes for retail investment. It can sometimes go badly wrong if the market takes a downturn. That can create real political headaches, widespread losses. Are they factoring that danger in?
Well, the sources suggest they're trying to mitigate that risk, partly by channeling these efforts through existing trusted structures, which brings us neatly to how these incentives are likely to be delivered. Because this isn't happening in a vacuum. The sources are very clear. These new policies, these incentives, they link directly to all the ongoing talk about individual savings accounts, ISAs, and self-invested personal pensions, SIPPs.
Okay, right. And this is where it gets really relevant for listeners, isn't it? Because ISAs and SIPPs, these are things people might already have or at least know about. So if the incentives are focused there, it's not like being pushed into some completely new, weird financial product.
Correct. And this is where we probably need to get slightly into the weeds because it's key to understanding the shift they want. When most people think IS, particularly everyday savers, they often think of a cash IS, which is, basically just a savings account where you don't pay tax on the interest. It's very low risk. Your capital is generally safe. And that's where a lot of this untapped money currently resides.
But the government wants them to look at the other main type, the stocks and shares ISA, which is different. That's where you hold actual investments funds, ETFs, maybe individual company shares. That means market exposure.
Exactly. That's the crucial distinction. The real policy game here seems to be about shifting capital within that familiar ISA wrapper, moving it from the safety of the cash ISA to the potential growth and risk of the stocks and shares ISA. So the new tax breaks and incentives will likely be designed specifically to make that stocks and shares version look far more attractive. Maybe they boost the overall ISA allowance, but say the extra bit must go into stocks and shares. Or perhaps a new break on capital gains made inside that stocks and shares ISA.
Got it. So they're using the existing pipes, essentially. People know and trust the ISA brand, broadly speaking. And the government is just tweaking the internal settings to make the investment option much more appealing financially. So for you listening, the decision frame shifts. It's less, should I start investing from scratch? And maybe more, should I switch my ISA type to get these better tax deals?
That's a great way to put it. That's the synthesis, really. The whole campaign boils down to using policy levers, tax and incentives, plus that public messaging around democratization to steer everyday savings towards the investment markets, but doing it through channels people already recognize, like ISAs and SIPPs. It's quite a sophisticated nudge using behavioral insights through financial policy.
And you mentioned SIPPs too, self-invested personal pensions. They're part of this push as well.
Yes, absolutely. SIPPs represent another huge pool of retail capital, obviously geared towards longer-term retirement saving. By improving the incentives within SIPPs, the government is aiming to make sure that retirement planning also leans more towards market investment, rather than just holding cash or very low-return assets within the pension. And arguably, since SIPP investors usually have a much longer time horizon before they need the money, they are theoretically better placed to handle market ups and downs. So it might be seen as a slightly less politically risky target compared to pushing people's easily accessible IS cash into the market. It's a fairly comprehensive approach, looking across different savings timeframes.
Okay, let's just quickly pull it all together then. What we've looked at today is this UK Chancellor's significant push for retail investment. It seems driven by a need for domestic liquidity and wanting higher retail participation in markets. The tools are new tax breaks, incentives to lower barriers, and this big marketing push using the democratization idea. And crucially, it's all being channeled through familiar structures trying to get people to shift from things like cash IOs towards stocks and shares ISAs and SIPP investments.
Exactly. Which leaves us with a final thought, really, for you to consider as this all unfolds. Given this clear government goal, getting everyday savers like you into shares and funds, you're likely going to hear a lot about these great new incentives, these tax benefits. It'll sound very appealing. The question you need to ask yourself is, how do you personally balance those potentially attractive financial benefits against the unavoidable increase in market risk that comes with it? It's something worth keeping firmly in mind when you see that democratizing message. Because maximizing your tax efficiency and managing your personal comfort with risk, well, They aren't always the same thing, are they? Sometimes they pull in different directions.